In this episode, we're going to go over the lessons from a $20 billion flash crash in crypto that almost no one saw coming and had some of the major players in crypto completely blow up, like some market makers and also some whales that lost over $60 million in a single day. We're going to go over the lessons that allowed us to survive this event and also the strategies and techniques you can use to survive these in the future or even better, maybe prosper from them. Padma, do you want to first go over, I guess, the idea of insurance and how that can work in trading?
Maybe first I could just like give a brief of what happened that night, like just just for people to get that are not maybe in the crypto space can get some idea. I was sitting on my couch, like just resting before going to bed, and it's normal. Like I open my phone, everything is down like 3%, 4%, normal stuff, normal variation on the market. I'm okay. But maybe like 10 minutes or 15 minutes pass. I look at my phone again and I see others and total 2 and total 3 like down 40 or 35 or 40% or whatever big number I saw. And I was like, no, this must be a bug. What the hell? I like rushed my computer. I see Hype, one of the largest tokens by market cap, like down in a few minutes from $40, it went all the way down to 20 on the perps. I see Ethereum down. I see most of the altcoins down 60, 70%. Like I've never seen that before. I'm in crypto since 2021, September. And I know that there was some periods like black swans like that in the past, but I've never seen that before. It was insane. Like 20 billion is what said it was liquidated. I think it was more because the exchanges underreport that, but it was just a crazy day. And on the insurance part, the idea of always having insurance is, for example, on a trend model, what we trade is like on a trend following portfolio, right? You trade both long and short. If you isolate the performance of the short models, of the short-sided models, on a market that is going up all the time, it's easy for a short model to make like at least a medium to long-term short model, trend following signals. It's hard to find a model that will make you a lot of money on the short side on those type of markets. Like most of the time it will be break even, makes a little bit of money, or even loses money. And some people like look it's a good question to make. It's like, okay, I have one side of my portfolio that is constantly losing money. Why should I keep it on? And yesterday you saw why. Even though you lose money most of the time, I make always the comparison of that to an insurance on your house. Okay, so an insurance, you're always losing money every month, right? You are always paying that premium. But once in a while, there's earthquakes, there's natural catastrophes, there's accidents, and that insurance that you paid all your life or how many years you paid is there to protect you to not lose the entire equity of your house, right? And that's the same idea for these models. Yesterday, people that ran long short portfolios did well or break even, which is very well on a day like that. If you did break even or a small loss, you did extremely well yesterday. And those that didn't, that had too much leverage, that were just exposed long, did terrible. Like they took very nasty losses because they got liquidated. Everybody got liquidated, and yeah, it is. It was a very bad day, and I think insurance is very important.
Yeah, I agree because I remember don't know if it was on an old podcast episode or something I put on Twitter, but someone basically responded with saying like, "Why would you ever add like a losing strategy to a portfolio?" And I was like, because strategies, or no, sorry, he said, "Why would you ever add a strategy that underperforms, like just beta or buy and hold, for example?" I was because different strategies serve different purposes. As you kind of said, no shorting strategy really in crypto is going to outperform BTC over the long run, or really like altcoins in the long run for the most part. So the only reason to have that is to have it as an insurance. And there's similar things in like futures, for example. So like in my futures portfolio, I have some strategies that not the highest Sharpe ratio, not the highest returns, but they stable my returns quite a lot, or just reduce drawdown in general. And while luckily in futures you don't have to as much protect for these crazy events, well, here and there I guess in some cases, but the reason also why this crypto one was the most difficult one to handle ever is, one, it was the biggest liquidation ever. At least I think I'm correct on that. And then two, because some market makers have definitely blown up during this, as Pedmo sort of witnessed, there was just bids that disappeared, and that's why it kept on crashing for way further than a lot of people expected. And it's also why some people are saying like, oh, you could have got some of the most amazing rebound trades on some of these positions because, for example, like Hype went down to $20. I saw a ton of meme coins drop like 80, 90% in a single day. I think ETH. I think was around a 10 or 15% drop, give or take. Like a lot of those would be amazing and easy buying opportunities, but the reality was there was almost no bids in sight. So to even try and get filled on that, for example, was going to be very difficult. And also, a whole other point of this is that exchanges broke. Lighter, which was a DEX, was down for 4 hours. I think the only exchange that was up without really much issue was Hyperliquid. But I do want to have one quick conversation about something called ADL. We were discussing it with people in our kind of like crypto group, and a lot of people I think are new to the idea of ADL. And primarily what this means is just auto deleveraging. So I was actually in a couple of short positions in crypto. However, while they still got quite good exits for the most part, they were exited before I even clicked exit or anything like that. And this is because of auto deleveraging. This is what happens when a DEX, for example, or even a centralized exchange like Binance, when there's too much volatility going on, too much exposure, and to protect the actual exchange itself, and also somewhat protect traders, they're exiting out of the position for you because the volatility is just too high. Think of it almost like a halt in classical equities in some essence, but obviously they're getting you out of the position instead of like stopping you trading happening during that period of time. And this did cause an issue where if you were short, for example, you would have expected your returns to be a lot higher. But for the most part, you were getting executed near-ish the bottom, but you weren't able to actually hold on to that short position for as long as you would have liked.
Yeah, yeah, that's and just to come back a little bit also on the idea of buying stuff, even if you wanted to buy on the way down, like most of the exchanges were broken, were crashed. Even
Yeah.
Binance was having issues. Like it was really hard. But yeah, on the issue of the ADL, this is the stuff that we talk about here. Why it's so important to get like live feedback from the market, because when you cannot backtest an ADL, right? That's a solvency mechanism for the platform, and positions that are closed are the nature of it is mathematical, and it is quite random. You don't know if your position, what positions will get closed, which shorts will get closed. What I saw was that a lot of the shorts were closed near the bottom, so that was kind of good. Yet at the same time, some of the like other shorts were not closed at the bottom, and then longs were left open that were losing money. So it's a mess, and it's quite random. And I don't see a way to protect against that, because it's a platform specific way of like risk mechanism, and it's quite random. So on those tail events, it's really hard. Yeah, it's really hard to like simulate for that. But in any case, if you had like a decently balanced long short portfolio, which a trend following model had, you did well, or did very small loss, or did break even, and that's the point of it all.
Yeah, completely. I will say, really, the only way to somewhat protect against this is just by general diversification, right? I
Yeah.
think this is also a big lesson from this event is that ideally, it depends on how big of your account and all these sort of things, but ideally, you don't want only one exposure to one particular market. You want to be exposed to classical equities, maybe some commodities, those sort of things, because then you're getting a general diversification. Plus, the most important factor is you don't have 100% allocation just in one market where you're going to suffer that full drawdown, for example. Um, I know a lot of people that are starting to diversify into crypto, and overall, while the event was obviously quite scary, they obviously went into a bit of drawdown because it wasn't 100% of their portfolio size. It's recoverable. At the end of the day, you can always make that back. It wasn't something that took you out of the game. Whereas there's definitely a lot of accounts on Twitter right now where for the most part, the one that comes to mind is I think he was like the white whale or something, his Twitter tag. He lost over 60 million on Hyperliquid in a single night. Like
Yeah.
just to think about that much exposure, and he also came out on Twitter saying that was considerable amount of his net worth, like it was almost most of it. I think he was left with about 500K on chain, and then apparently he had paid off for some stuff in life. But having that much exposure, in my opinion, now obviously I haven't achieved as much success as being able to grow something to 60 million as him, but I would never have exposure of 60 million if that was the majority of my net worth to one particular exchange, market, really anything. I would definitely want to diversify that, and that can be one way to help limit from some of these flash crashes or just crazy events that happen. Because well, this is just a really quick point. Your biggest drawdown is always going to be in your future. These events will always be happening in the future, and you can't really foresee them or predict them. You just have to be able to know that do you have mechanisms in place to try and protect you as much as possible? And one of them is definitely diversification and limiting exposure to some extent.
100% I agree. And if you made that sort of money, like I don't understand. Again, I don't want to like he's done it somehow. So I haven't done it at that level. So I don't want to say I know better, but like if you've done that kind of cash, I don't understand how you are so exposed, like so exposed to the point that you lose everything if something happened. There's so many idiosyncratic like risks to this market that a single hack, like a single misclick of a contract that you sign or of a link that takes all the information from your browser and all that money is gone. Yeah.
Yeah, no, I would definitely agree. I think it's because people become somewhat complacent, and also they're not preparing for the unexpected. There's a lot of things in markets that can go wrong. Like, ironically, I found this very funny that legit the last podcast episode we went over was me having a broker issue where I couldn't exit out of position. I lost 7K. I will say, in some weird way, that was now a blessing because I took off a lot of exposure just because I wanted to change some stuff around on my brokerage side of things, and that helped quite a lot because I didn't get as much suffered from the equity side of things. Crypto, primarily was almost break even just because we had shorts on, but for the most part, that was a blessing in disguise. But
Mm.
still, I was never really prepared for that, and it was because I somewhat got complacent. And I think these events can definitely happen, whatever market you are, even in crypto, even in equities. You just have to be thinking about how you can diversify and also, maybe employing some strategies that are acting as an insurance, where maybe you're not making a ton of money from them, but they do serve a purpose in your own portfolio.
Same, man. Like you just hit a very important point. Like these last few days events, it just showed me so many things that I need to improve. Like it has been instrumental for what I'm going to do next. There's so much that it has showed me that I think that the money that I've lost on that day, it's so small compared to what I've learned. And I don't say that lightly because I don't like to lose like everyone. And you know,
Yeah.
it, but it's like we were saying, like you learn that lesson from the problem you had with your exchange. I've learned this lesson with this major crash. And to be honest, we are being battle tested. If you can survive the worst liquidation event ever, like the worst liquidation event ever, you can survive anything probably over the long term, or you are very well positioned. So I see that uh, more positively, let's say.
Yeah, I agree. I'd say like always the worst events that have happened to me in trading have always led to the most growth. I will say, if I'm kind of trying to put it into a timeline, most of the time the worst event happens, let's say like my brokerage loss, and then it will be about a couple of days of me being sort of upset or annoyed about it in general. And then from there,
Yeah.
once a week or so later, you pick it up and you realize the lessons you could have done better, and then you work from there and you keep on improving. And that's ultimately, I think, just the sign of progress and how you can get better.
Yeah, and it's like we're saying, we always think that you just learn that on the job. This is not something that you can learn on a book. Sure, you can read from someone that got liquidated or lost their entire account or wherever, but when you go through it, like that's where you learn. That's where you are forced to learn. Otherwise, you're going to do that again. And trust me, you don't want to do that again. Luckily, we had good risk management. We survived. We took I took a loss, but it's all fine, and we are going to grow out of it, and we learn a lot. And that's the way you do in business. It's just like you learn and continue to improve.
Completely. I do want to bring up one boring topic. I know people will probably click off on this, but it's really important. And if you're like an actual proper trader and you're maybe even full time trading, I think it's a very important thing. A big thing for these sort of events is making sure you have some cash on hand, you have savings in hand, so that you can spend some time to recover from these sort of losses because they will happen. Whoever's thinking that there's not going to be another liquidation event in the future or there's not going to be another thing that happens is ignorant. It's going to happen, so it's good to especially if you're full time to maybe have a year of savings, maybe two, depending on how much portfolio size, all those sort of things, because within a year, within 2 years, it's definitely possible to bounce back. But if if you're left with only a week or 2 weeks of savings or something, that's a very difficult thing to do, and it'll probably make you make even worse decisions, probably put on more leverage or even stupider trades. So having that sort of breathing room can make you think clearly, and also it removes a lot of the stress. Well, not all of it, but it removes a good amount of that stress for when these events do happen.
Yeah, for sure. Having something on the side, like a services or business or even a job, and even if you don't have that, have some savings and some like real life stuff being taken care of, it's most important. Because if you're going to act scared, and now you're like on the back foot or trying to recover everything on one go because you need to pay bills or whatever, that's a very, very tough position to be in. You need to be in a position that you're rational and taking logical decisions with positive expectancy over time. Otherwise, you're just going to make mistakes.
Completely. One last topic, at least that I had in mind, was are we going to make another SPY trade, similar to what we did? I think it was 6 months ago, give or take. And I think it was just a small tangent I want to put on this podcast for that. If Trump does continue these sort of China things, it seems like he's somewhat backpedaling already, and everything will probably look fine for Monday. But if he doesn't, especially the key date really is November 1st at the moment for the trade talks. So I do at least see in my own kind of like, let's say, discretionary trade or discretionary allocation for long term, I'm going to be trying to buy a lot of these dips slash any crazy days we get, like SPY yesterday was down 2.7%, almost 3% in a single day. If we get a couple of more of those days, if we get anywhere near 600, give or take, I'm definitely loading up as much as I can possibly, because realistically, he's not gonna. If you think long term enough, this is going to recover within a couple of months, and probably even sooner, because knowing Trump, how fast he goes back on these sort of things.
Yeah, this year has been the year of the taco trade, right?
Yeah.
The Trump always chickens out trade. Like everything that he says or does or something like that is not a political statement. It's just the reality. Like everything that, like on the tariffs, whatever, everything else, it has always had like a back trace, like a retrace of that in the markets, then end up recovering. So we'll see if we get very good discounts, we'll take them as they come, and we'll see in the future what happens.
Yeah, I think a lot of it is he loves that short-term volatility so that he can kind of remove the bad news, or the bad news can be negotiated, and quickly the market's spiking up and moving. Because if you think about what happened since the drop in April, if I remember correctly, SPY's up 30% from those lows. So I
Yeah,
think even in a
we
six-month
bought all
period.
of that.
Yeah,
Yeah.
exactly. Like we bought a decent amount. I just wish I had done that trade even stronger. And I feel like if he's going to do somewhat of a similar event, 100% I'm going to lean into it. Obviously, I'm not going to leverage up the whole portfolio or anything crazy like that, but I'll be there waiting if we get some solid dips.